Start investing in gold and silver today at sdbullion.com and join the over 35,000 precious metal investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest-growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today and start saving on every precious metals purchase you make.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is their good friend from Denver, Dave Kranzler. Dave, great to have you back on the show.
Thanks for having me on, Doc. Appreciate the opportunity always.
All right. Well, it's been an interesting week again in the markets here this week. As we record Friday afternoon here, gold and silver down quite a bit again here on Friday. Silver actually had recovered the 17 level on Thursday, but was knocked back below 17 here. Trading right around 1690 here this afternoon. And as gold is lost yesterday's gains as well, trading back around 1160, a little bit below that, but not too much, but hovering right around that 1160 level. My take remains the same from what I talked about in last week's show. It really just seems eerily reminiscent of the market action in November and early December and a year ago in 2015 ahead of the FOMC statement and then the rate hike announcement. It seems that the market has almost fully priced in another rate hike next week here, guys. So let's start with that. Dave, what's your take as we head into the big Fed news that's pretty much been baked into the cake, in my opinion?
Well, I think, and I track this on a daily basis, and if you look at the market action on a 24-hour basis, you'll see that in general and on average, now it's not necessarily true every night, but in general and on average, really since August, but for sure since the election, gold seems to drift higher or move higher during Indian and Asian and Eastern Hemisphere market trading hours. And then it sells off when London opens, and then it really gets hit when the COMEX opens. And I differentiate between the physical delivery markets and the paper markets. Some people still think London is a physical delivery market, and it's really not. It's become a paper derivative market. In fact, just chatting about this with someone yesterday, if you recall, there was a guy, I think his name was Ken Warnholtz or something, I forget, but he was talking about how it's shocking how empty the vaults are in London. And I would suggest the same thing is probably true on the COMEX if we were to be able to get an independent bona fide audit as opposed to just the information that the banks, who are the primary market makers on the COMEX, they're the only ones that are providing us those reports. And I've always said that if JP Morgan is honestly reporting its COMEX data, then it's the only part of their business model that they're reporting honestly, because we know everything else is fraudulent. So to that extent, I think that, again, the takedown is largely in the paper market. It's been kind of reinforced with this narrative out there that interest rates are going higher, so gold's going to go lower, which is nonsense. I mean, there's been a couple studies done that have shown since 1971, something like 2/3 of the time during Fed interest rate hike cycles, gold actually goes higher. So that's a misinformed narrative, and
we saw that last year.
Right, and if interest rates are going higher, it also should be taking the stock market down with it. So, I mean, it kind of tells you how silly this is. However, there's another interesting attribute to the paper argument that I'm making, and that is if you look at the Commitment of Traders report, and again, I understand it's based on, bank data, bank reporting, which is sent to the CFTC, and they create these reports. However, it is showing that, well, first of all, there's been a massive decline in COMEX gold futures open interest since August. I mean, it's down something like 40%, close to 40% since it peaked out. It was either late July or early August. And so I'll be anxious to see what it shows today in terms of the relative positioning. But over the last few weeks, the commercial banks, which is sort of the producer merchant plus the swap dealers, the commercial sectors, primarily the banks. There's some hedgers in there, some legitimate hedgers, but they've been significantly reducing their net short position by increasing their longs and decreasing their shorts. For instance, the swap dealers took down the short side of their open interest by over 15,000 contracts last week, and they increased the long side. And conversely, the hedge funds, which is the managed money category, has been unloading their longs, and they've been piling into the short side. And that's usually a characteristic that we see when a market takedown operation is really kind of running out of steam and is about to end. And so I think a lot of what we're seeing on the COMEX, when the COMEX opens, is the hedge funds go in there and their computers automatically, when interest rates go higher, the algorithms automatically have them unload paper future contracts into the COMEX system. And I think that's been a large part of the takedown that we've seen since the election.
Yeah,
go ahead.
I
I think this is I think it's coming to an end. I don't know exactly where we're going to bottom out, but I noticed, on Monday, the December future hit a low of 1158.50, and today I think it hit a low of 1157.50. So we'll see what happens. And again, we're going into another FOMC meeting, and they usually hit the crap out of gold going into a meeting. But lately, gold actually been rallying after these meetings, so we'll see.
Now, guys, let's talk a little bit about the big news of this week, that silver manipulation has been confirmed by Deutsche Bank. And not only confirmed by Deutsche Bank, but they ratted out a handful of their co-conspirator banks. It's quite interesting that our friends like Jeffrey Christian have called us crazy for years for alleging silver manipulation, kind of like the whole fake news meme. But the big picture, the news is coming out here at a time when sentiment is horrible. So my question is, Dave, is this news going to affect silver prices at all? Maybe not today or tomorrow, but in the big picture, how does this news affect silver prices?
I don't really know if it's a positive or a negative for silver prices. I mean, you may get some people out there say, "See, I told you the market's totally manipulated. I'm staying out of it, and I'm selling everything I have." I mean, I doubt people who own physical will sell their physical, but it may reduce participation. But on the other hand, if it slows down the manipulation at some of the offending banks that were mentioned, it should be a positive for the market. On the other hand, probably what will happen is, the banks that were named will make an example of these traders. They'll come out and say, "Well, we weren't aware of this, blah, blah, blah." What I found most interesting about the news report yesterday, and I'm actually surprised it hasn't been commented on, and I haven't had time to write a blog post about it. I mentioned it in my mining stock journal last night. I threw some analysis in there about it, and I might reproduce it on the blog. But there was a notable absence of J.P. Morgan's name in the allegations of support documents, and it doesn't make sense to me that J.P. Morgan would not be mentioned. I mean, that was when Andrew Maguire gave his testimony in that CFTC hearing back in 2010. I mean, he specifically showed the CFTC board members information, that was emails at J.P. Morgan, and I guess there was also recorded phone conversations. So it was interesting to me that J.P. Morgan is by far the largest market maker on the COMEX and silver. It's got the largest silver vault, and it's also the custodian for SLV. And I don't know that the data is readily available, but I'm sure they're one of the larger market makers in LBMA forwards, so silver forwards. So to me, the real root source of the market manipulation in the metals starts with the BIS and goes down to the Western central banks, the Fed, the BOE, and the ECB. And they have banks like JP Morgan. Citicorp wasn't mentioned, and they're now like one of the largest market makers on the COMEX. And so you have, some big market making banks that I believe are the agents for the central banks in the manipulation scheme, and they weren't mentioned. So I think it's just going to, let's slap the wrists or blame it on the specific traders at these banks, and we'll issue very light fines to these banks, and then it'll be business as usual. I mean, that seems how every sort of that's how the regulation to Wall Street is applied. Slap their wrist and then continue looking the other way.
And adding on to that, for those who may not recall, or for those who are newer to the market, back in around, I want to say the 2011, 2012 timeframe, if I recall, JP Morgan was the one bank that had whistleblower employees come out with detailed information and documents alleging manipulation of the silver market. So that's why one of the main reasons why JP Morgan had so much information on it as being the center of the manipulation. But I mean, you're undoubtedly right, Dave, that JP Morgan is likely not the ultimate mastermind of it, but most likely probably just carrying out U.S. operations for the BIS.
Well,
right. Go ahead, Eric.
I mean, they are one of the primary clearing firms that participate on the London exchange. So by very definition, even though they may not have some smoking gun linking up to them when it came to the fingering of manipulation of the PM fixing, which is basically what the whole lawsuit was about with respect to Deutsche Bank, first and foremost, and never mind all of the other discovery items that have been outed in the process of this whole settlement. The reality is that JP Morgan is involved with all of the movements in the markets in London. But in a bigger picture, the settlement is basically a way in which they can contain the damage. It's going to nominate problems within other banks that they'll just excuse away. It's the pattern that they've done pretty much with everything. In fact, we were talking earlier in the call about how JP Morgan has basically had accounting games in so many places that when we look back in the last 5 years, JP Morgan has paid over $30 billion in fines. And then it's quite literally a cost of doing business for them.
And it's a minor cost of business.
In the grand scheme of things, that's really how it works out. But $30 billion, good grief. I mean, it's just monumental what's going on in our marketplace. And in the financial press, the so-called guarantors of miscreants like Dave and silver doctors and so forth as being fake news, they don't, put that into the proper perspective. We have one of the largest banks in the world that has been outed for, criminal activities that have been excused away. And they have paid fines and settlements over $30 billion in the last decade because of it. It's just unbelievable.
Let's shift our topic a little bit here to interest rates in the bond market, particularly with the Fed meeting coming up next week. And we've seen a massive move in rates in the past month since the election. And I think it's going to affect the housing market soon if it hasn't already. You're seeing that in refinancing numbers plunging. I think it's also going to start to have a pretty big effect on sales, valuations, et cetera, across the country. So let's dive into that and rates and where we see the market heading as we take a look into 2017.
Oh boy, I hate to try and forecast anything in this market because there's so much intervention going on. The truth is, it's part of what I think is driving interest rates higher right now is I think China's been, I think they've kind of increased the rate at which they're unloading U.S. Treasuries. And with, at least on the surface, it looks like the Fed isn't really printing much money right now. They're not. I think the only quote unquote QE they're engaged in is they're reinvesting interest from their mortgage portfolio to buy more mortgages. But
right.
Again, who knows? Everything is so opaque at the Fed. You don't really know what's going on. But I think part of the gap up in interest. I mean, the Fed, if anything, they're going to do a 25 basis point hike in December to save their credibility. And honestly, if they're going to raise more than that, they're going to risk putting the whole economy into a tailspin, which I think it may be going into anyway. So, in terms of the effect on the housing market, you're definitely it's for sure affecting refis. I'm positive that there were probably a fair amount of refis that were in the system that hadn't rate locked by the day after the election, and if they waited a couple days to rate lock, a lot of those probably would have been disqualified from getting a refi done because the credit ratios are being done at such tight levels right now that they're highly sensitive to interest rates. I know I was helping a friend with a refi, and we rate locked the day after the election, and if we had waited another day, she would not have been able to. She would have lost her pre-qualification for a refi because of the higher interest rate would have increased her credit ratios to the point where she wouldn't have been able to get a Freddie Mac backed refi. So it has to be the case that the same thing is happening with new purchases. I know the week after the election, or it might have been 2 weeks after. So, and I don't follow this on a weekly basis anymore because it's so manipulated, but I know the purchase mortgage index was down like 30%. So, it's going to affect that. It's also going to affect auto sales. Auto sales are already starting to crumble. So, and I don't care what the seasonally adjusted annualized rate of sales numbers are reported. I mean, those are in and of themselves manipulated. And I posted an article on my blog today from John Crudell of the New York Post, who went through and talked about how the retail sales numbers are manipulated. And he picked up on some things that I had never really considered or looked at before. But if you go by what the auto finance companies are saying, their mortgage applications and their auto loan applications and auto finance activity is starting to decline very quickly. So that, the reality that's being reported from the private sector is, once again, diverging from the manipulated headline numbers that are being reported by industry organizations or the government.
And from the 50,000-foot level when it comes to the credit markets, I mean, it's pretty darn clear that that's where the biggest problems are. The rot in the financial system, particularly in Europe, the credit spread stress that we can see with the huge explosion in the spread between the 10-year Bund and the 10-year U.S. Treasury. We saw over a 60 basis point rise, a rocket shoot rise in the last 30 days in the U.S. Treasury, 10-year bond that basically, if memory serves, is the fastest, most compressed period rise we've ever seen, or at least the second most. The kind of ferocity of what just happened is monumental, and we're still moving up, just slower. I think the bond market, and I've been talking about this for months, I think the bond market is going to be the black swan that takes everything down. And we've seen 60-plus basis points in 30 days. We can easily see another 100 basis points to the 10-year added in the next 3-4 months, given the kind of trends that are going on and the reversal of this kind of, just the insanity of the amazing amount of manipulation targeting the credit market created the biggest bubble in financial history in all time. That's the kind of scale of the problem we have in the bond market. And I think it's going to start blowing up in 2017. It's already started, and the kind of rescue operations and the intensity of going after precious metals is part of the process of the powers that be trying to control what's going on in the bond market. And in fact, it's probably to a large extent why we are seeing the precious metals sector being attacked this very moment, today, Friday, leading into the FOMC meeting, because the central bankers and policymakers understand how the momentum has completely shifted when it started happening following the election, and major changes are happening, particularly with the credit markets, but we can see individual countries doing some pretty strong things too, like the gold takedown at the Shanghai with China this week. I mean, everywhere we look, we see things that are just completely Six Sigma deviations from what we would consider to be normal. And I'm just, throwing out a number, hypothetically, metaphorically rather, to describe what's going on. When I look at the markets now, I can't believe my eyes. I can't believe what we just saw within the credit market in the United States and the Treasury exploding 65. I mean, Dave, you hail from the credit markets, and that's your background. Have you ever seen anything like that before in real time? I mean, it's just astounding to see what we just have gone through, and it's still going on.
Well, we're up 60 beeps since the election. We're actually up 100 basis points since the beginning of July. So, that's a full percentage point, and that's not in response to the threat of a quarter point rate hike by the Fed. I mean,
hell no.
It's already priced in a quarter point rate hike. So, no, there's a fundamental problem, and I agree with you, Eric. I do think that the biggest bubble of all time, the credit market bubble, is
there's major air flying out of it.
Yeah, I don't know if I would call it major air quite yet, but there's definitely a little more than a pinprick.
I'll put it to you this way. There's a heck of a lot of people around in the conventional finance world that are now starting to talk about it in terms of the fear of the unexpected possible black swan to arrive. I mean, that after we saw that 60 basis plus point move following the election, it basically was a bitch slap to people to wake them up to see what the kind of problems we have. I think there's a lot more people in the conventional finance world that are very, very nervous about what's going on, and that, in fact, speaks to why we are seeing as much manipulation as we are in this very moment.
Yeah, I think there's no question about it. I think that and again, I think the hedge funds are responsible in a major way for this push up in stocks. Yeah. But I think it's being enabled by the Fed. I mean, if the Fed's not outright printing money and giving it to the banks to put into the to help push the stock market higher, I would suggest that the Fed has loosened up on its credit lines to the banks, and the banks have loosened up on their credit lines to the hedge funds. In other words, I know from a friend of mine who works at a pension fund, that pension funds are pulling money out of the active management strategies. That means hedge funds aren't getting cash in per se. So to the extent that they're driving the market higher with their algos, it has to be based on the availability of credit. And I think that's the tool here that's being used to push the stock market higher. I mean, you'd have to be insane to think that any of the programs that Trump have proposed are really going to be value added to the economy or to earnings.
Certainly the magnitude of the move is not explained by any kind of forward expectations. I mean, that's definitely, as far as I'm concerned, goes without saying.
The other story here to tie in with the precious metals and in the bond market and interest rates is China and their war on cash that's threatening to develop into a war on gold as well. I'd like to hear your thoughts, Dave. Number one, whether you think this is a move by the Western banking system to put a cap on or a chokehold on India's gold demand, number one. And then number two, if so, how might that impact the silver market in silver demand, as presumably Indians would shift their demand to silver?
Well, that's a good question. And I agree with you. I think, to the extent that they try to prevent or make it harder for the Indian populace to buy gold, they're going to shift to silver. I think we saw that when they initiated that, moved up the import duty to 10%, if memory serves me correctly. I think, and
right.
I don't know that there's really
and
data.
Also, just a quick historical interjection. India used to primarily purchase silver until it was around 100 years ago, where the same type of thing, new tariff import duties on silver, changed India's appetite from silver to gold. So it's certainly, in my opinion anyways, not inconceivable that appetite could shift right back to silver.
Right. And what's interesting about that is I don't know of any source that tracks the amount of silver going into India, just like there isn't any source that tracks the amount of silver that goes into China. But I do think, and again, I can't prove it. I can look at footprints in the snow and speculate on where they lead, and that's about it. I do think that it was, a Western BIS-led directive that pushed Modi into, eliminating part of the cash, the currency supply in India. And the cover story was, well, we want to target the black market operations. But I don't think there's any coincidence that, and I think it was in the last year that the former head of the Indian Central Bank, the Royal Bank of India, is now one of the vice chairman of the BIS. So those are the kinds of footprints that I'm talking about. And I think it's going to backfire, and I think that I don't know how much anti-government violence is going to foment over there, but I think that if the excuse is they're trying to target gold smuggling and black market money laundering, et cetera, I think it's going to make that situation even worse for the government to deal with. And I will say that in terms of the John Brimlow newsletter that I get every day, there's obviously reports out there that demand for gold in India is down. Well, that's incorrect, because the premiums, the market premiums being paid over there are at a level and have been at a level for at least the last 6 to 8 weeks, which indicate that there's a lot of gold being purchased in India. And the same thing with China. There's reports that China's constricting imports. Well, I haven't seen any evidence of that. I mean, if the World Gold Council comes out and says, well, there's less gold going into China in terms of gold going from Hong Kong into China, it's not showing up on the delivery reports into the Shanghai Gold Exchange, which are about as high as I can ever recall seeing them since I've been paying attention to the data. So I guess there's again, it's, when you get a market like we're in right now with the precious metals, and especially when they're driven by the paper markets, you get a lot of disinformation, misinformation, and outright just fake news. It's propaganda. They're trying to suppress the sentiment in the West towards gold as an investment and a wealth preservation tool. So you get all these reports. Indian gold demand is dying. China's restricting gold imports and demand over there is going down. Well, that's not true based on the numbers that I'm seeing, and this is data that gets reported by the Shanghai Gold Exchange every day.
Yeah, and the whole trends with silver in response to the crackdown on gold in India is actually pretty darn interesting. We've seen a veritable explosion in terms of the silver demand in India versus trends in gold, and it started in 2012 when the Indian government began to ratchet up its efforts to try to control physical gold into India. They care about the current account deficit, and they're worried about that blowing up because of the imports and how, if you're purchasing something as an import, you're taking your currency, and to explain this for our listeners, the people who are buying gold in India are creating demand for gold that forces the purchase of gold that's priced in U.S. dollars with Indian rupee, and that puts huge pressure on the current account, and people in India, the policymakers, are very concerned about those kind of things, and so that's part of the reason why they're cracking down, just from the organic desires of trying to control the ass backward financial system that India has managed to create itself. And then you plug that into the global context of the worldwide financial fiat paradigm that we are all swimming in, and the pressures that Dave describes as far as the Western policymakers putting the screws on India has in fact happened. I mean, Doc and I have talked about how Ben Bernanke, what was it, John? I don't remember when it was that Ben went over there, flying over there to go and make nice with the Bank of
it was
of India.
It was both Bernanke and Geithner, if I recall correctly.
Yeah, right. I mean, they went over there with baseball bats, basically. And that was back in what was 2012, interestingly enough, somewhere around that time frame, a little earlier maybe. So, this is the context of what's going on in India is a multi-act play that's been going on for years, and it's ultimately going to blow up on him because too many people use gold and silver as a store of value because the depreciation of the rupee against an ounce of silver over the last 40 years is over, well, it's darn near close to 40,000%.
Man, Eric, I miss those guys. I miss Bernanke and Geithner. It was just too easy.
I think they put in Yellen because she's like an archetypal grandma and is not easy to pick on.
I think you're exactly right. It's not fun. It's like a grandma who's like asleep.
And yeah, you just missed doing the punt the Bernanke thing they used to do on SilverDoctors.com.
You're dang right I do. We're going to have like 10,000 listeners doing a Google search trying to find that, see what the heck we're talking about.
Yeah, go back and play the game. Hopefully those old pages are still up.
Oh, man.
I mean, seriously, I think that the silver demand in India is going to respond. The policymakers in India are so damn myopic that they're not going to be able to see this coming very easily and deal with it. I mean, look at the ham-fisted way that they've tried to implement this, restriction of the 1,500 rupee note and all of the various things they're now doing to go after, gold. I mean, it's just they're flailing around and completely incompetent. And this is a recipe for disaster. There literally are people dying because of these economic policies. They're hurting the poor terribly. And this is going to blow up on India.
All right.
And it's also silly, too, ultimately, and I've made this point before, if India, and this would never happen, but intellectually, from an economic point of view, theoretically, India could simply just, as a nation state, as a sovereign nation state with its ultimate power, theoretically, if they so chose, to simply declare gold importation as the purchase of money, and that would not blow up the current account deficit, and that would be immediately, overnight, or within a short period of time, if they change the way they actually process their current account problem, that problem would disappear too.
That's actually a really good point.
It expresses, in fact, the very nature of our fiat paradigm worldwide and the nature of why it's just a fucked up paradigm. Excuse my French. It creates problems.
That's a really good point, because if it was classified as currency,
you got it.
Product, the outflow of rupees would be offset because
you'd be purchasing an asset, and it wouldn't be a problem to the current account.
Yeah.
Instead, it's being treated like people are purchasing a BMW from Germany. It whacks the current account.
That's a great point. You should write an article about that, Eric.
That's been written about by a lot of people, actually. I'm not,
I haven't seen it.
Savant that saw that. That's understood, but not frequently commented about. And the reality is that that's how stupid people in the policy establishment are in India. They are literally killing thousands of people this last, ever since these policies were put into place. Literally.
Probably more than 1,000.
I'm not being hyperbolic.
Yeah, it's quite sad and humorous at the same time that while the gatekeepers and the central bankers of the world and the mainstream media,
we're a bunch of fake news proprietors
that are actually literally killing hundreds and thousands of people. I mean, just look at Syria. I mean, that killed thousands of people, displaced millions, and yet and yet they accuse the alternative media of one getting shot in the floor. So everything needs to.
Let's take 30 seconds and unpack that. I mean, let's use the example of Syria and unpack it. We are supposedly supposed to believe that everything wrong going on in Syria is the problem with Russia, right? I mean, that's essentially the paradigm meme and propaganda meme that is injected into the public mind via our dear fake news, CNN, Washington Post. Fuck you guys for calling us fake. I mean, seriously. The other day, the editor of the Washington Post basically had to backtrack and cover the company in the face of possible lawsuits.
Right, only because they're being sued.
Yeah, they will be and are being called out and seeing their credibility diminish because people recognize that they are, in fact, the fake news proprietors and not the alternative media. And certainly amongst the list that was, or many lists that have been published, there's a lot of sites on there that I would never go to because I think they're lousy sites and they produce crap. But that doesn't mean that we should kill the First Amendment just because some special interests claim that they are examples of, propaganda. It's more along the lines of just the simple fact that they're just producing crap. And, when it comes to Syria, and I do want to unpack this, in 2013, we almost had direct U.S. military attack on Syria. And that whole situation, combined with what are essentially false flags that went into place when, the worldwide media tried to paint Assad as basically attacking his own people with weapons of mass destruction, chemical weapons, that was also unpacked and neutralized by the diplomatic efforts of Russia and ultimately Obama actually being copacetic with that. And we didn't have a kinetic, aggressive, direct war with U.S. troops on the ground or airstrikes or what have you, which were, in fact, only about a week and a half away. That benchmark in time, that point in time, is pretty significant because prior to that, Russia actually wasn't involved within the Syrian war theater at all. For the most part, I mean, they have this ongoing relationship because they are strategic allies, but Russia was not a participant in this war theater that has been going on. And if people looking at the situation today were to just partake in the narrative from the mainstream media, we're supposed to believe that this is all Russia's fault. I mean, even in the election, Hillary Clinton and her involvement within the Democratic National Committee basically screwed Bernie Sanders and manipulated the primary. And in order to deflect from attention from that, the interests within the Democratic Party tried to claim that literal emails proving with 100% accuracy and certainty that this, in fact, is what happened. Instead, the problem is reframed as, Russian hackers delivered the email to WikiLeaks, and that's the problem, and therefore let's change the subject. That's the nature of how everything is happening in this whole fake news paradigm attack that we're experiencing is just that example.
Yeah, we could give dozens more, but we'll wrap the show there for now due to time considerations. So before we go, Dave, if you can let the listeners know where to find your regular excellent work over at Investment Research Dynamics.
Oh, well, thank you. By the way, I'm sitting here eagerly awaiting the delivery of my silver maple leafs that I bought last week, taking advantage of your sale that you had.
Yeah, we've been running a couple pretty good sales on maples. I think we might do one more here coming up next week. We'll see.
I'll probably be buying some more next week, too. I can't wait because I only own Silver Eagles, so I'm excited to see the...
Oh, you'll like those maples. Did you get current year ones? If you got the new ones, they're pretty nice to look at with that micro engraving.
I don't remember. I can't. It was the dates of our choice. Was that a little bit less expensive than the current year?
Yeah. So prior to 2015, maples didn't have the micro engraving. So you have to see what you get. If you get 15 or later, we'll have that micro engraving on.
I think I got the micro engraved ones. I think that's one of the reasons I wanted to get them. I wanted to check that out, but also because it was on special. So of course, it appeals to my sense of value.
Yeah, it's interesting that all the major mints are copycatting the Royal Canadian Mint on that now. Here with their 2017 coins, the Royal Britain Mint or Royal British Mint with their Britannias, they went to a microengraving. The Perth Mint has gone to some microengraving with their kangaroos, but not the U.S. Mint. Everything stays the same for 30 plus years.
At any rate, my blog is Investment Research Dynamics at investmentresearchdynamics.com. I actually have a pretty interesting article on there about retail sales and the consumer. It turns out November retail sales were down another 1.3%. I mean, not retail, restaurant. Restaurant sales this year for about the last 6 or 7 months have been a complete disaster, and to me it reflects the general condition of the consumer, and I think it's going to show up not necessarily in the propaganda retail sales reports from the government and the industry associations, but I think it'll show up in the company reports when retailers start announcing how their holiday sales went right after the first of the year. And from my blog, I offer the Mining Stock Journal and the Short Sellers Journal, which are two very reasonably priced subscription services. So that's where you can find my stuff.
And I've read all of Dave's work, and I think that his newsletters are indeed very reasonable for what he does. And you're going to get information from Dave that is, in fact, deemable as fake news, because investmentresearchdynamics.com is on the same list as silverdoctors.com and the newsdoctors.com, because we dare to actually try. We don't always get everything right, but at least we try to look around and try to report on what is going on. And that's why investmentresearchdynamics.com is on the same list. Dave does great work, and I think everybody should help him out by helping everybody out by building our own media, paying attention to the Washington Post and all of the other mainstream media are seeing their audiences shrink at a rate that is astounding. And that's because people are waking up and realizing that the kind of stuff that Dave does, that I do at the News Doctors, that John and everyone else does at Silver Doctors, is where you're going to begin to get perspective that at least will paint the picture with enough color so that people can at least understand what's going on, as opposed to fake news, CNN, Washington Post, on, that purposefully obfuscates from the very first step they take.
And with the propaganda blitzkrieg that's going on against real news, I'm reminded of a quote from a couple hundred years ago that if we don't all stick together, if we don't all hang together, we shall surely hang separately.
Dear Ben Franklin.
So we'll close on that note. Let's hang together and support all those sites that made the list.
I second that.
All right. So for the doc, Eric Dubin, and our friend Dave Kranzler, thanks for tuning into this week's SE Weekly Metals and Markets.